I was expecting to see Nassim Nicholas Taleb sitting across from me. Instead, on October the 31st, Halloween, we have Black Swan Man?
Well, I mean, this is Halloween. Happy Halloween, everyone. This is a joke made by a few friends and colleagues, and I guess today is the day to wear it.
Today would be the day to wear it.
This cartoon, to represent a bunch of...
There's an online comic book, Black Swan Man.
Yeah, and also to represent a bunch of ideas embedded in that cartoon.
So, the cartoon, and people can see it, blackswanman.com, bills you, effectively, as the fearless feathered hero guarding against the evil and destructive forces of risk. So let's get serious for a moment.
But let me tell you, they got it wrong because I'm not for perfection, just like these characters, cartoon characters, looking to be super something. You want to be as fallible as possible and figure out that we human make mistakes, we're human, and you're just as fallible as others, and find where the mistakes are going to lead to catastrophes.
Okay, so that's what you were doing in the lead up to 2008.
And that's what we're here to discuss today. Where is the vulnerability? Why is the world today more fragile than it was, say, in 2007?
It's more fragile today than it was in 2007.
Of course, because we have the same symptoms. We have absolutely the same disease. You put Novocaine on cancer. And what happens? The patient isn't going to get better. He's going to feel better, look better, maybe for a while, and at some point you have a higher price. Think about it. What was 2007? What was a crisis of debt?
It was a debt crisis. There's no question.
We have a lot more debt today.
But it's in different places. There's been a consumer deleveraging, and the housing market isn't nearly as levered as it was back then.
Yes, but you don't get a free lunch. In other words, different places does make a difference. Now, where is it? It moves to governments. From
and corporate balance sheets.
And corporate balance sheets. And corporate balance sheets, of course, it did fuel the stock market rally with corporation either investing their cash, with zero interest rates in their own stock or borrowing in many cases. I mean, we have $2.some trillion additional corporate borrowing. And then, of course, governments. Governments, they think they borrow for free till, they need to borrow a lot. So either they got to print money or borrow at higher and higher rates. I mean, we have to borrow more than this year, more than $1.some trillion. That's $1 trillion or something. And then think about it, we're incurring higher and higher.
When you say we, you're speaking of the U.S. government.
U.S. government, taxpayers, we're paying for it. We're paying, $300-some billion of interest.
Every
year. Higher rates, more interest, higher rates. You may enter a spiral.
What does that mean?
It means
what is a debt spiral in your mind?
In my mind is when governments have to borrow. It's like a Madoff scheme, when you have to borrow more and more to pay interest. A Madoff scheme or a Ponzi scheme, but let's call it Madoff, is when you have to borrow to repay creditors. And that's what we are doing. The minute you enter that phase, there's nothing healthy about it from an economic standpoint.
That there is a large amount of federal debt is not new to the United States.
Yeah, but we accumulated additional 10 trillion last phase since the crisis.
Right.
Okay,
and even more now with the tax cut and the need.
We're accumulating more and more. Plus, we have
the deficits.
Plus, we have hidden liabilities that should count as debt.
Like
Social Security, you have hidden liabilities. You have hidden liabilities when you have to bail out firms. When you have we have hidden liabilities from student debt that are not going to be. I mean, you have a lot of things, a lot of debt that, I mean, if you committed to some expenditures, so on top of the nominal debt, you have some hidden liabilities that should count like debt.
Nassim, let's work with your analogy.
Yes.
Right? Every Ponzi scheme eventually collapses.
Everyone, practically.
This Ponzi scheme,
I mean,
again, in your term, is going to collapse as well?
I mean, we're starting to see, you remember years ago we had debt crisis, and it starts in countries like Argentina, starts in 82, it started in Latin American countries. Today, this is hitting the core, it's not the periphery. It's hitting the core. We start having countries like Italy, and it's getting close to us ourselves. We have to borrow a lot. So the point, how do you get out of the accumulated debt?
Are you predicting a sovereign debt crisis?
I am not. The thing will translate itself into some other measures, okay?
Like what?
Like, for example, in the U.S., usually what do you do to get rid of debt? In the past, okay, the normal solution is inflation. But the minute you start creating a little bit of inflation, it's so uncontrollable. It's an animal that we have learned from the 70s is not easy to tame. So if you try to increase the base inflation, hopefully to work yourself out of debt, it's going to be the price, stability will not be there, and it's going to be traditionally has been not controllable. So I think we're hitting a point where you need buyers for your debt.
Sure.
The Chinese and the oil producing states, were regular customers. Maybe they're not going to be there. Okay. Plus, you need more and more. So at some point, don't tell me it's healthy. It's not going to be healthy. So that's
but what I'm trying to understand, and what everyone who's listening to you right now is trying to understand, is how does it play out? We saw how it played out in 2008.
Yes,
right. In 2007, 2008, there was a collapse in the subprime mortgage market, and then it metastasized, right, into a collapse of the housing market, and ultimately it almost took down the financial system.
2008, we transferred the debt from individuals to the states. Okay, that's 2008. So you had at least a way to do things, and we could lower rates as monetary policy to zero, which of course didn't help, because you don't cure a structural problem with monetary policy. It should be there only as emergency measures. Now, 10 years later, okay, we're starting to raise rates because you have to raise rates. You can't keep them at low level. It's unhealthy to keep them at low level. You're going to raise rates. So someone's got to pay the price. Who's going to pay the price of higher rates? A lot of people who benefited from that free money, namely corporations.
Over-levered corporations.
And especially real estate. So the first shoe to drop would be probably real estate. Real estate, because real estate is very sensitive.
Okay.
And the higher end real estate has already been going down worldwide without anybody
people
talking about it, because people notice, but they don't talk about it because it's not shown yet in the numbers, because that's what quantitative easing increased, among other bad things, inequality. And
so real estate is most vulnerable.
Higher end real estate first,
right,
and then the rest of real estate, as we saw.
You predict another collapse in the real estate market.
It will start with real estate. If anything, odds are we'll start with real estate, and then we'll see
what comes after that.
Stock market. Think about it.
Is that what we're seeing today?
No, what we're seeing today is nothing.
Not today specifically, but the last couple of weeks.
No, but think you cannot maintain a high valuation in the stock market in the presence of high interest rates. Plus interest rates, typically, from my experience as a volatility trader for 35 years, the problem is high interest rates. You always observe on the high interest rate volatility that get masks with low interest rates. So with higher interest rates, we're going to see some volatility.
Nassim, people know you for the prediction, if you will.
Not prediction, for risk detection. I'm not,
No, but they equate you with a person who effectively predicted the financial crisis.
I didn't predict. I showed the risks of a system that was fragility of system. My specialty is fragility of system.
I understand.
So you can call it prediction if you like, but...
No. Yeah. I'm not saying that you're a predictor. I'm saying that people equate you with that.
Yes.
Okay, and you've told me at the beginning of this conversation and at several points along the way that you believe the system today is more fragile than it was in 2007.
Yes, exactly.
When we had the greatest financial crisis.
It's the same fragility that we have from 2007 that we masked.
In more than 70 years.
So
where do we go from here? Do we go to another crisis that's worse than the last one?
What we need, the thing that would save us, all right, miraculously, is either growth without debt. What we're seeing here now is 4.2% growth with debt. It doesn't work. Real growth, maybe miraculously, would take us out. Or maybe some kind of inflation that would not cause too much price instability. And we've never seen that. Okay, it's smooth inflation. Unless we have these two, all right, we're doomed.
What do you think happens to interest rates?
We're going to be forced to have them higher. But, you don't.
How much higher? Today, if I look at,
I don't know how much higher.
The 10-year is 3.15 and the 30-year is 3.40.
Look at what will happen from interest rate. We have to borrow more than $1 trillion. Okay, today. For next year. Now, if you raise interest rates, and we have a lot, if you raise interest rates 100 basis points, think of the cost on the total debt. Okay, we're already paying, part of the deficit. 380 billion come from interest servicing, debt servicing. So think about it. You have a spiral coming from that, is that you have to borrow more just to pay the interest more and more. That's a deficit by itself. The other miracle that can happen is if we suddenly figured out a way to fix the mandatory spending and lower these monsters that we have of $2 trillion.
As you've said, your expertise is identifying risk and evaluating fragility.
Yes.
But we both know that fragility has consequences. You've already said that it's going to manifest in possibly a collapse in the real estate market, that it's going to hit the stock market. If interest rates go higher, obviously bond prices go lower, so that there's no safety in the bond market. Is there anywhere that you can see that's actually safe?
Maybe we have some, I'll tell you what I do, because skin in the game. I own some gold, but I'm confused about it. I just own it just in case.
Okay.
I own some gold just in case they decided to create inflation or something, just to be safe. I own some land that has not appreciated considerably because a non-speculative area that produces olive stuff. But I don't see anything except watching your cash inflation hedged, and also if you own stocks, have put protection, have some kind of way to limit your downside, because the tail risks are as big, if not bigger, than they were 2007 and before that.
Nassim?
So I'd worry about tails.